Alright folks, as I promised in my previous weekly outlook, here's the full breakdown of what to expect this winter, a deeper look at the latest EIA forecast and what it really signals for natural gas heading into 2026. The agency may be leaning bullish, but as we've learned time and time again, nat gas loves to flip the script whenever winter demand comes in soft. Let's dive in. According to the EIA, Henry Hub is expected to average around $3.90 through this winter, with a short-lived January peak near $4.25. That's the classic seasonal setup, higher prices as heating demand intensifies and consumption reaches its winter peak. This year, the EIA is also counting on stronger LNG export flows to add an extra layer of support. Inventories closed out October nearly identical to last year and slightly above the 5-year average, yet October prices still averaged around $3.20, about 45% higher year over year. And for 2026, the EIA expects an average Henry Hub price of $4, roughly a 16% increase from this year. A key pillar of that bullish outlook is the rapid expansion in LNG capacity. Plaquemines LNG just received approval to introduce gas into Block 17, about 0.14 billion cubic feet per day, bringing the final piece of the 2.6 billion cubic feet per day terminal online ahead of schedule. That early startup prompted the EIA to lift its export outlook for the fourth quarter by roughly 3%. Looking into 2026, Golden Pass Trains 1 and 2, along with Corpus Christi Stage 3 Blocks 4 to 7, are expected to begin shipping cargoes, collectively adding another 2.1 billion cubic feet per day of export capacity by year-end. But here's the part the market can't ignore. Even with LNG growth accelerating, domestic consumption is expected to weaken this winter. The EIA projects lower U.S. natural gas usage during the 2025-26 heating season because temperatures are forecast to run warmer than last year. Residential and commercial demand, mostly tied to space heating, is expected to average 36.5 billion cubic feet per day, down 5% from last winter and 2% below the 5-year norm. Early November has already been warmer across much of the country, and NOAA's outlook continues to show above-average temperatures across the south-central and southwest. Overall, the EIA expects 3% fewer heating degree days than last winter. And this is where natural gas often pulls its classic move. When winter demand undershoots expectations, prices tend to soften, even in years with strong export expansion. We've seen this dynamic play out many times, with only rare exceptions like the speculative spikes of 2022 and last year. So while the EIA paints a structurally bullish landscape for 2026, much of the expected increase in LNG exports is already baked into current elevated prices. That means the possibility of a winter-driven correction remains very real. If early season demand disappoints again, prices could easily come under pressure, no matter how strong the LNG growth story looks on paper. And keep in mind, this market has a well-established pattern of front-running winter, with prices often surging in anticipation of higher heating demand. Yet more often than not, those early gains get reversed once the season is underway, especially if actual temperatures align with forecasts or turn out a bit warmer than expected. On top of that, producers are always eager to ramp up output when prices spike, which tends to put downward pressure later. As many traders like to say, high prices are the cure for high prices. Essentially, a hype before winter doesn't always translate into sustained price strength once real-world conditions hit. Overall, given the current supply-demand balance and storage levels, today's price levels feel significantly stretched. Historically, for much of the past decade, similar structural conditions have supported prices closer to $3 or even below. For example, winter averages from November through March during much of the 2010s often ranged between $2 and $3. Yes, the geopolitical risk premium, mainly tied to potential new sanctions on Russian energy firms, is largely already reflected in today's elevated prices. While additional restrictions could have some impact on Russia's LNG exports, I remain skeptical that this factor alone is enough to justify the current price levels. Why? Because Russia has repeatedly demonstrated resilience in its LNG business. Despite sanctions, its LNG exports to Europe remain sizable. In fact, Germany's LNG imports from Russia reportedly surged over 500% in 2024. That suggests Moscow still has ways to route gas, and customers willing to buy, even under geopolitical pressure. As many traders like to say, the bees seem powerless against the honey. In short, while geopolitical factors can't be written off, I lean toward the view that current natural gas prices are overbuoyant. The market may be paying for fears rather than fundamentals, and if demand disappoints or sanctions don't bite as hard as hoped, we could be in for a sharp reset. If you have your own take on where natural gas prices are headed, drop your thoughts in the comments and join the conversation. And yes, feel free to buy me a coffee or use YouTube Super Thanks if you'd like to help keep this channel going. On the charts, Henry Hub futures are looking technically bullish, moving averages and most indicators are flashing positive signals. Prices recently bounced back around $4.50, and we've got a cluster of pivot levels right around $4.55 that traders are watching closely. On the upside, key resistance sits near $4.60 to $4.65, and if momentum really kicks in, we could even test $4.80. On the flip side, support zones are around $4.40 and then $4.30 if the market decides to pull back. So what does this mean for next week? We're in a cautiously bullish zone. Expect some consolidation around the current levels as the market digests recent gains. If weather forecasts or LNG export news support the upside, we could see a push toward resistance. But if early season demand disappoints, or storage numbers come in higher than expected, prices could quickly retreat toward support. The takeaway? Momentum is on the bullish side, but don't get too comfortable. Natural gas has a history of spiking ahead of winter only to pull back if the real-world demand doesn't match expectations. So watch those $4.45 and $4.60 levels, they'll likely define the story for next week. Thanks for being here and I'll see you in the next one.